Wall, he's the CEO of Wall Financial Group. Michael, what do you make of this report out of Moody's that maybe the debt ceiling should not be a factor in the debate because they've mismanaged it so poorly down in Washington, D.C.? Maybe this adds to uncertainty.
You know, I think it absolutely does. You know, everybody that we talk to, and of course the things you continue to hear, you hear about the debt this, the debt that, you know, what's going on in Greece, what's happening here. And I think we really haven't seen any real clear solutions. I mean, you're seeing a government that's wishy-washy. They like this, they don't like that, they can't come together. And that creates uncertainty. I mean, unfortunately it does. But at the end of the day, I think even if the debt ceiling is raised, in my opinion, I still think there's a lot of things out there that are deeper wounds that we're just putting Band-Aids on in the global economy.
You're not wrong. We just had Nicholas Swan of S&P. He's the director over there of cutting sovereign ratings, and he flat out told Fox Business exclusively, yes, we know he's already said that there would be a 50% chance of the downgrade, but within 90 days. And he clarified that today, saying people assume that means by October 6th. Nuh-uh. He said it could happen within the next couple of days. It depends on whether they really start to see some serious weakness. Do you think this is a possibility?
I think so. And I mean, you know, at the end of the day, if the S&P does downgrade, I mean, what's that going to do to the overall markets? And that's why right now my sentiment really is bearish. Because, you know, I would love to say that we're going to have a banner year over the course of the next year or the next, but, you know, we're still in a situation where consumers are fearful. We had a really great 2009. 2010 was, you know, kind of mediocre, and here we are in the middle of 2011, and people are kind of saying, small business owners are still in a situation where they're fearful with the health care bill coming out and all that's going on that way. So, you know, I think there's a lot of uncertainty still yet there. Now, there are still some plays, I think, where consumers can be profitable in these times. But if you chart the markets, if you chart the Dow specifically, and you go all the way back to 1900, and you come up until now, what you're going to see is you're going to see a lot of 20-year flat periods and roughly 6 to 10-year bullish periods. And I really believe that we're in the middle of a 20-year flat period right now.
All right,
you know,
Michael,
we've had the lost decade over the last 10.
What happens to the stock market in the short term? I mean, the S&P has already said this is a short-term problem because the U.S. will try to move quickly to cure a potential downgrade. If you know, the Congress, by the way, and the President has to decide to default on the debt. A debt ceiling, you know, blowing past the deadline doesn't mean immediate default. What happens to the stock market? What happens to the bond market? Already BlackRock saying the Eurozone crisis is keeping the 10-year note at, you know, down by about 30 to 40 basis points. Where do you see those two markets in the event of a downgrade to AA?
That's a good question. I think the stock market, equities, that type of thing are going to see a, you know, a drop in the short term, if you will, primarily because consumers are going to be scared, not sure what to do, you know, kind of trying to get out and get on the sidelines and wait and see. As far as interest rates and things like that, you know, I believe that interest rates are going to kind of stay uniformly low for a little while until we see some of the dust clear and dust settle. So I don't think we're going to see a big push up that way, which, you know, obviously if interest rates go up, bond par values come down. I don't think that's going to happen, but I do think in short term, if there is a downgrade, I do think we're going to see some drop in the overall market, equity markets, because of fear and concern about where is this all going to end, essentially.
Do us this favor. Make us some money. Make our viewers some money. Where should we be putting our cash if we have some? Is there a bet here and there that you would take, knowing all that you know?
You know, I think there is, and I think probably the first things you need to understand as an investor themselves is, do you want to do this on your own, number one, and number two, if you don't, are you looking at short-term or long-term plays? And quite honestly, you know, there's a couple things that I like right now that I think that makes sense for investors. First thing is, most of the folks we work with, it needs a preface that they're 55 plus. So a lot of people, they're fearful right now of saying, you know, I want to make sure that I can maintain the kind of lifestyle that I've had. So we like using the hybrid annuity as a piece of the pie because we can lock in some of the gains and not lose them all. Just a piece. Now, what I will say is there was a study from the Wharton School of Business, which you're probably familiar with, that actually compared these hybrid vehicles to the S&P since 1996. Came out December last year really strong. Non-traded REITs are good, and I'd like the healthcare sector too.
All right,
I like the healthcare sector.
Healthcare. All right, Michael Wall, thank you so much for your ideas there. Really appreciate it.